This is a Valentine's Day card. Pink envelope, embossed hearts, the kind you'd buy at a drugstore for $4.99. Inside, a message about love and commitment and forever. Standard romantic fare, nothing unusual. Now look at the date on your calendar. February 14th, 2026. Valentine's Day. The day the card is supposed to be opened, the chocolates exchanged, the dinner reservations honored. That same day, while couples exchange gifts and restaurants serve prix-fixe menus, $15.4 trillion in financial derivatives reach simultaneous expiration. Options, futures, swaps, and structured products across equity, fixed income, currency, and commodity markets all settle on February 14th, the largest single-day derivative expiration in financial history. $15.4 trillion, roughly 60% of U.S. annual GDP, concentrated into a single settlement window that spans 16 hours across global time zones. The positions that have accumulated for months and years converge on one date, one moment, one reckoning. This is not about romance. This is about a squeeze so large, so interconnected, so hidden from public view that even most professional investors don't understand what's about to happen. The mechanisms are technical. The participants are institutions. The numbers are so vast they become abstractions, but the consequences will be concrete. The Valentine's Day that arrives in 15 days will not end the way it begins. Markets that open normally will close in conditions that haven't existed since 2008. Prices that seem stable will move in ways that reveal who was prepared and who wasn't. The card costs $4.99. What February 14th costs depends entirely on whether you understand what's converging on that date, and whether you've positioned for the collision before the collision occurs. Here's what they're not telling you. The $15.4 trillion figure comes from aggregated data across 6 major exchanges and 4 clearinghouses: COMEX, CME, ICE, Eurex, the London Metal Exchange, and the Options Clearing Corporation. Each exchange publishes open interest data. Each clearinghouse reports notional exposure. The aggregation is straightforward for anyone willing to compile it. What's not straightforward is understanding why February 14th became a convergence point of this magnitude. The answer lies in a calendar quirk that most traders overlooked when positioning 18 months ago. February 14th, 2026 falls on a Saturday. Derivative contracts that typically expire on monthly options expiration dates, the third Friday of each month, shifted their February 2026 expiration to Thursday, February 12th, standard calendar adjustment. But quarterly futures, which expire on specific calendar dates regardless of weekday, maintain their original settlement date. The March 2026 quarterly futures technically settle on March 20th, but the roll period, when positions must be closed or extended, begins February 14th for the front month. The collision of adjusted monthly expiration with quarterly roll initiation creates a 2-day window where more contracts require action than any single window in exchange history. Positions that would normally spread across separate dates compress into February 12th to 14th. At 3:15 a.m. Eastern on January 15th, exactly 30 days before the expiration window, the Options Clearing Corporation published its monthly systemic risk assessment. The document runs 847 pages. Page 312 contains the relevant passage. Concentrated expiration exposure during the February settlement period exceeds previous stress test parameters. Enhanced margin protocols and liquidity monitoring will be implemented effective February 1st. Exceeds previous stress test parameters. The clearinghouse responsible for guaranteeing that derivative contracts settle properly is telling member institutions that the February convergence exceeds the scenarios they've planned for. The enhanced protocols taking effect February 1st include 25% increase in initial margin requirements for positions expiring in February, mandatory intraday margin calls for accounts showing unrealized losses exceeding 5%, and position reduction guidance, recommending members reduce February exposure by at least 15%. The guidance isn't mandatory, but guidance from your clearinghouse about systemic risk carries weight. The institutions receiving this guidance are now attempting to reduce February exposure simultaneously, creating selling pressure in markets where everyone wants to exit the same positions at the same time. The mechanism that was supposed to prevent a squeeze is triggering the squeeze. The margin increases force leverage positions to close. The closures create price movement. The price movement triggers more margin calls. The spiral accelerates. This is where the lie becomes unsustainable. The derivative market exists in a parallel universe to the physical assets derivatives reference. A gold futures contract references gold, but doesn't require holding gold. An S&P options contract references stocks, but doesn't require owning stocks. The paper instruments trade independently, creating prices that supposedly reflect underlying asset values. The paper versus physical distinction applies across every asset class in the February convergence. The $15.4 trillion in expiring derivatives includes $4.2 trillion in equity index derivatives, options and futures on S&P 500, NASDAQ, Russell 2000, and global indices. These instruments reference stock portfolios worth approximately $48 trillion. The derivative notional represents 8.75% of underlying equity value. $3.8 trillion in interest rate derivatives, Treasury futures, Eurodollar options, swap contracts referencing $127 trillion in outstanding government and corporate debt. The derivative layer represents 3% of underlying bond value. $2.7 trillion in currency derivatives, forex options and futures on dollar, euro, yen, yuan, and emerging market currencies. Daily forex volume exceeds $7.5 trillion, but concentrated expiration creates settlement demands that normal daily liquidity doesn't address. $2.1 trillion in commodity derivatives, including $890 billion in gold and silver contracts alone. These instruments reference physical commodities that have already demonstrated delivery stress under normal conditions. $2.6 trillion in credit derivatives, credit default swaps, synthetic CDOs, and structured products referencing corporate and sovereign credit quality. These instruments amplify any credit event by multiples of the underlying default. Each category faces its own version of the paper-physical problem. Equity derivatives assume stocks can be bought and sold at index prices, but concentrated selling exceeds market-making capacity. Interest rate derivatives assume bonds can be delivered, but Treasury market liquidity has deteriorated since 2020. Currency derivatives assume forex markets remain liquid, but they assume this during the largest coordinated expiration ever attempted. The divergence between paper and physical that gold markets have demonstrated becomes the divergence between derivatives and underlying assets across all markets simultaneously. The February 14th settlement requires that $15.4 trillion in paper claims reconcile against actual assets. The reconciliation assumes markets function normally. Markets will not function normally when 60% of GDP equivalent seeks settlement in a 2-day window. The premium that physical gold commands over paper gold, currently 30% plus, may appear across other assets. Physical treasury bonds may trade at premiums to futures prices. Actual equity shares may diverge from index levels. The paper-physical split that seems specific to precious metals becomes a market-wide phenomenon. When institutions do what they're doing now, they're not hedging. They're building lifeboats while the ship still looks stable. At 9:45 a.m. Eastern on January 27th, JPMorgan Chase filed an 8-K supplement disclosing material changes to derivative portfolio composition. The filing revealed that JPMorgan had reduced gross derivative exposure by $2.1 trillion since December 31st, a 12% reduction in total notional in 27 days. The reduction focused specifically on contracts expiring February-March 2026, $2.1 trillion in exposure reduction from a single bank in less than a month. The reduction required closing positions that other market participants had to absorb, positions that moved markets as they unwound. Goldman Sachs filed similar disclosure on January 28th, $1.4 trillion reduction in Q1 expiring derivatives. Bank of America, $890 billion. Citibank, $720 billion. Morgan Stanley, $615 billion. The 5 largest derivative dealers in America reduced February-March exposure by $5.7 trillion in January alone. They weren't speculating about whether the convergence posed risk. They were de-risking with urgency that their filings now document. The filings reveal something else, the direction of the reductions. Each bank reduced short positions more aggressively than long positions. The ratio of short reduction to long reduction across the 5 banks, 3.2 to 1. The banks were disproportionately short. They held positions that profited if prices fell, across equities, across bonds, across commodities. The $15.4 trillion convergence threatened those shorts. The de-risking was short covering at institutional scale. Short covering creates buying pressure. The banks that dominated derivative markets as short sellers are now becoming buyers, competing with each other and with every other participant who needs to cover before February 14th. Less than 15 days remain before the expiration window. The de-risking that began in January accelerates as the date approaches. Each day closer to February 14th increases urgency for remaining short positions. Each urgent cover creates price pressure that triggers more covers. The countdown is mechanical, not emotional. February 14th arrives regardless of positioning. The contracts expire regardless of readiness. The settlement occurs regardless of liquidity. The margin calls that clearinghouses threatened are now being issued. Since February 1st, when enhanced protocols took effect, intraday margin calls across major clearinghouses have averaged $47 billion daily. Normal levels run $8 to $12 billion. The fourfold increase represents positions under stress, accounts scrambling for liquidity, the squeeze tightening. The liquidity required to meet margin calls comes from somewhere. It comes from selling other assets, drawing on credit lines, liquidating positions that weren't originally part of the expiration. The contagion spreads from derivative markets to cash markets to credit markets. Each margin call creates selling pressure somewhere. While Western institutions de-risk, Eastern institutions position differently. At 8 a.m. Beijing time on January 29th, 7 p.m. Eastern the previous day, the People's Bank of China published guidance for domestic financial institutions regarding international derivative exposure management during periods of external market stress. The guidance, translated by financial analysts within hours, contains specific instructions. Domestic institutions should limit new derivative positions with Western counterparties during the February settlement period. Existing positions should be evaluated for counterparty risk and, where appropriate, reduced or novated to domestic counterparties. China is telling its banks to reduce exposure to Western derivative markets before February 14th. The instruction implies Beijing sees counterparty risk in Western institutions, the possibility that derivative contracts won't settle as promised because Western banks face their own liquidity stress. The counterparty risk concern is not paranoid. During the 2008 crisis, derivative counterparties failed. Lehman Brothers' collapse triggered cascading settlement failures that required government intervention to resolve. The $15.4 trillion February convergence creates conditions where similar failures become possible. If a major derivative dealer faces margin calls it cannot meet, its contracts go into default. The default triggers credit events on related instruments. The credit events trigger more defaults. The cascade accelerates until intervention stops it, or until it burns through the system. The Chinese guidance suggests Beijing is preparing for this scenario. Reducing exposure to Western counterparties insulates Chinese institutions from the cascade. The insulation allows China to observe the February stress from outside rather than experiencing it from within. Russia issued similar guidance to domestic banks on January 30th. The BRICS finance minister's January 27th call, disclosed through Indian government sources, discussed coordinated risk management during anticipated Western market volatility. The Eastern Bloc is building walls around its financial system. The walls suggest they expect what's inside Western markets to become dangerous. They're not building walls for markets they expect to function normally. The BRICS positioning extends to physical assets. Gold imports to BRICS nations accelerated dramatically in late January, 147 tons to China, 84 tons to Russia, 62 tons to India in the final 2 weeks of the month. The metal is being removed from Western circulation before the February stress tests physical delivery systems. The geographic bifurcation that has characterized precious metals markets now characterizes the broader financial system. Western institutions are trapped in a derivative structure facing unprecedented expiration stress. Eastern institutions are reducing exposure and accumulating physical assets. The two blocks enter February in fundamentally different positions. This is what a system looks like when it runs out of time. The $15.4 trillion derivative convergence didn't happen by accident. It accumulated through years of position building, roll extensions, and calendar timing that concentrated exposure onto a single date. The concentration was invisible while markets functioned normally. Individual positions were manageable. Individual expirations were routine. The system absorbed normal settlement demands without stress. But normal is not what February 14th presents. The convergence exceeds stress test parameters by the clearinghouse's own admission. The de-risking by major banks, $5.7 trillion in 1 month, demonstrates that the institutions closest to the exposure consider it dangerous. The trap has no exit that preserves all positions. The $15.4 trillion in contracts must either settle, roll forward, or default. Settlement requires counterparties to perform, delivering assets, providing cash, honoring obligations. Rolling forward requires finding new counterparties willing to take the other side of existing positions. Default means contracts fail to settle. Each path has consequences. Settlement in stressed markets produces prices that reflect stress rather than fundamental value. Rolling forward in a market where everyone wants to roll concentrates exposure on remaining counterparties. Default triggers the cascade that Chinese and Russian institutions are positioning to avoid. The likely outcome combines all three. Some positions settle at stressed prices, some roll forward at expensive terms, some default. The distribution across outcomes depends on liquidity conditions that no one can predict, but that the de-risking patterns suggest will be challenged. The metaphor that traders use is the eye of the needle. $15.4 trillion must pass through February 14th settlement window, a window designed for normal volumes, not historic convergence. The needle's eye is too small for what's trying to pass through. Something doesn't fit, something gets stuck, something breaks. What breaks may not be visible immediately. Derivative failures often take days to cascade through interconnected positions. The February 14th settlement occurs over the weekend, Saturday, when markets are closed. The full impact becomes visible only when markets reopen on Monday, February 16th. The three-day gap between expiration and market reaction creates uncertainty that compounds the stress. Positions that expired Friday sit unsettled through the weekend. Counterparties that failed to perform can't be identified until Monday. The information void fills with fear. Those who understand the convergence are positioning before it arrives. Since January 15th, when the OCC published its stress assessment, portfolio repositioning has favored assets outside the derivative system. Physical gold purchases at dealers have increased 340% relative to January 2025. The buyers aren't speculators betting on gold prices. They're institutions and individuals moving capital outside a derivative structure they no longer trust. Treasury direct purchases, buying government bonds directly from Treasury rather than through secondary markets, have spiked similarly. The buyers want the actual bonds, not derivative exposure that references bonds. Cash holdings at money market funds have increased by $89 billion since January 1st. The holders want liquidity, not positions that might face margin calls or settlement failures. The migration from derivative exposure to direct asset ownership accelerates as February 14th approaches. Each day, more capital moves outside the system that faces the convergence. The movement validates itself. As capital leaves, remaining positions face greater stress, encouraging more capital to leave. The question is not whether February 14th creates market stress. The clearinghouse documents confirm stress exceeds planning parameters. The question is magnitude. How severe does the stress become? How long does it last? How far does contagion spread? The magnitude depends on variables that remain uncertain. How much additional de-risking occurs before the 14th? How markets absorb the settlement demands? Whether any major counterparty fails. The answers emerge only when the date arrives. What's not uncertain is that the preparation window closes on February 14th. The positions held when expiration arrives are the positions that experience whatever that expiration produces. There is no repositioning during settlement. There is no exit once the convergence begins. 15 days remain. The de-risking continues. The margin calls accelerate. The Eastern Bloc builds walls while the Western Bloc manages exposure. The Valentine's Day card in its pink envelope waits to be opened. The $15.4 trillion squeeze waits for no one. Reality asserts itself through convergence dates that arrive whether participants are ready or not. The February 14th expiration is not a prediction or an opinion. It's a calendar fact. Contracts that exist, settlements that must occur, mathematics that must reconcile. The hidden $15 trillion squeeze is not hidden to those who read clearinghouse reports, track open interest data, and observe institutional positioning. It's hidden only to those who rely on headlines and assume that markets always function normally. Markets do not always function normally. They function normally until they don't. The OCC's assessment that February exceeds stress test parameters is the institution responsible for normal function saying, "We're not sure February will be normal." The banks de-risking $5.7 trillion in 1 month are the institutions that make markets saying, "We want less exposure to what's coming." The Eastern Bloc reducing Western derivative exposure is the alternative financial system saying, "We don't trust your system to perform." 3 different categories of observers: the clearinghouse, the market makers, the geopolitical rivals, reaching the same conclusion through different analysis. The convergence of their conclusions matters more than any single data point. What you hold on February 14th determines how February 14th affects you. Derivative exposure, long or short, faces the squeeze directly. Physical assets outside the derivative system face only indirect effects. Cash faces margin call demands but not settlement failures. The choice between these positions is not a prediction about market direction. It's an assessment of which exposure you want during the largest derivative settlement event in financial history. The banks chose reduce exposure. The Eastern Bloc chose build walls. The informed individuals chose move to physical assets and cash. What remains is your choice. The pink envelope waits until February 14th. The $15.4 trillion doesn't wait. It's converging now, through every de-risking trade, every margin call, every position adjustment. 15 days until the date arrives. The hidden squeeze becomes visible. The system discovers whether it can pass $15.4 trillion through the eye of a needle. The card costs $4.99. The squeeze costs whatever you hold when it arrives. Position accordingly.